Accounting. Accounting as a noble profession, a cornerstone of business, finance, and organizational success. In a world brimming with diverse professions, accounting holds a unique and indispensable position. Let us delve into the reasons why accounting stands tall among its peers. Among many factors, the first is decision making. Accounting is not merely about numbers, it is the language of business. In any organization, decisions, both big and small, are made based on financial information. Accountants play a pivotal role in providing accurate, timely, and relevant data that leaders use to make informed choices. Choices, whether it is strategic planning, resources allocation, or assessing the financial health of an entity. Accountants are the architects of sound decision making. Secondly, accountants are guardians of financial integrity. In a world where trust is paramount, accountants serve as a guardians of financial integrity. Through meticulous record keeping and adherence to ethical standards, they ensure transparency and accountability. The financial reports produced by accountants are the bedrock of trust for investors, creditors, and all the other stakeholders. Without this assurance, the foundations of commerce would be shaky at best. Thirdly, driving economic growth. Accounting is not confined to the backrooms of businesses. It is a driving force behind economic growth. By providing a systematic and standardized way of measuring and reporting economic activity, accountants contribute to the stability and development of economies. They enable businesses to secure funding, attract investments, and create job opportunities, all of which are essential for societal progress. Fourthly, adapting to change. In an era marked by rapid technological advancements, the accounting profession has proven its resilience and adaptability. Accountants have embraced innovations such as cloud computing, artificial intelligence, and data analytics, revolutionizing the way financial information is processed and analyzed. This adaptability ensures that accountants remain at the forefront of facilitating efficient and effective financial management in an ever evolving business landscape. Lastly, upholding ethical standards. Accounting professionals adhere to a strict code of ethics, emphasizing integrity, objectivity, and professional competence and due care. The trust placed in accountants is not solely because of their technical skills but also because of their commitment to upholding moral and ethical standards. This ethical foundation distinguishes accounting as a profession of trust and integrity. By definition, accounting is the systematic process of recording, analyzing, and summarizing financial transactions of a business organization, and its goal is to provide accurate and timely information about the financial performance and position of an entity, enabling stakeholders to make informed decisions. Accounting is mainly divided into six branches. The first one is financial accounting, the second is managerial accounting, the third is auditing, fourth is tax accounting, fifth is forensic accounting, and lastly is cost accounting. Let's look at each of the branch separately. Firstly, the financial accounting. Its objective is to provide external stakeholders involving investors, creditors, regulators, etc., with accurate and transparent financial information about a company's performance and financial positions. For example, preparations of financial statements, income including income statement, balance sheet, cash flow, and notes to the accounts. These all statements showcase a company's revenue, expenses, assets, liabilities, and equity. Second branch is managerial accounting. Objective of managerial accounting is to provide internal management with relevant information for decision making, planning, and control. Reporting include cost analysis, budgeting, variance analysis, and performance reports. For instance, a manager might use managerial accounting to analyze costs associated with producing a specific product, which helps in pricing decisions or cost cutting measures. Moving forward is auditing. Objective of auditing is to examine and verify financial information to ensure accuracy, compliance, and reliability of financial statements. Auditing can be an external or internal. For example, in case of external auditors, auditors review a company's financial records, transactions, and internal controls to provide an independent opinion on the fairness and accuracy of the financial statements. Next one is tax accounting. To ensure compliance with laws of tax and regulations and to optimize a company's tax positions. It involves the preparation of corporate income tax returns, analyzing tax implications of business decisions, and providing advice on tax planning to maximize tax liabilities. Forensic accounting. Its objective is to investigate financial discrepancies, fraud, or irregularities within an organization. A forensic accountant may be called in to examine financial records and transactions to uncover embezzlement, financial fraud, or other financial misconduct. Cost accounting. The objective of cost accounting is to analyze and control the costs associated with producing goods or services. Its example includes the determining the cost per unit of a product, analyzing the cost structure of a manufacturing process, and identifying areas of cost reduction to improve overall profitability. If we consider the historical background of accounting, it starts from ancient Mesopotamia. In ancient Mesopotamia, people engaged in barter trade. Clay tablets were used to record transactions involving goods and services. For instance, a farmer might trade a certain amount of wheat for a carpenter, and this transaction would be recorded on a clay tablet. Then comes the ancient Egypt. The Egyptians engaged in agriculture, created accounting system to track their grain and livestock. They used hieroglyphics to document the quantity of grain stored in granaries or the number of livestock in their herds. In 15th century, there comes the double entry accounting. Luca Pacioli in the 15th century introduced the concept of double entry accounting. Imagine a merchant selling goods. In double entry accounting, the sale would be recorded in two accounts: the revenue account for the income from the sale and the inventory account to reflect the reduction in the goods available for sale. The balanced approach ensured that assets equal liabilities plus equity. And then comes the Industrial Revolution. During the Industrial Revolution in 18th and 19th century, businesses expanded and transactions became more complex. For instance, a textile factory might purchase raw cotton, incur production cost, and then sell finished goods. Accounting systems evolved to manage these intricate transactions, tracking expenses, revenues, and inventories more systematically. In late 19th and early 20th century, there was a need for the formation of professional accounting organizations. With industrialization, companies grew larger and the need for reliable financial information increased. Professional accounting organizations like the American Institute of Accountants were established to set standards. Accountants started applying principles to ensure consistency, reliability, and transparency in financial reporting. There comes the globalization and technology. In 20th century, with the rise of multinational corporations, accounting standards needed to become more globally consistent. International financial reporting standards were developed to facilitate uniform financial reporting practices across border. Additionally, the introduction of computers and software streamlined accounting progresses, allowing for faster and more accurate record keeping. Today, advancement in technology such as cloud computing and data analytics have revolutionized accounting. Consider an e commerce business analyzing customer purchase data to optimize inventory levels. The integration of sustainability metrics into financial reports reflects the growing importance of environmental and social responsibility, aligning with contemporary concerns about corporate impact beyond financial performance. The historical developments of accounting can be traced through simple examples that reflect the evolution of record keeping from basic barter transaction to the sophisticated and globally standardized system used in the modern business landscape. To conclude, we can say that accounting is more than just a profession. It is a bedrock upon which businesses, economies, and societies thrive. Accountants are not just number crunchers, they are stewards of financial truth, architects of informed decisions, and catalysts for economic progress. As we acknowledge the importance of various professions, let us recognize the indispensable role that accountants play in shaping a world where financial transparency, integrity, and informed decision making pave the way for a brighter future.